A glimmer of growth. China's industrial profits are on the rise. The latest economic figures from China, as of May 2025, paint a picture of cautious optimism. Industrial firms, the backbone of the nation's manufacturing prowess, have reported a noticeable uptick in their earnings. In April 2025, profits at these large enterprises climbed by 3% compared to the same month in the previous year. This marked an acceleration in growth. It was a step up from the 2.6% increase observed in March 2025. This suggests a gathering momentum in certain segments of the Chinese economy. The data provides an early signal that government efforts to stimulate activity might be bearing fruit. From January to April, cumulative industrial profits saw an increase of 1.4% year-on-year. This steady, albeit slow, improvement indicates a gradual recovery path. The numbers are being watched closely by analysts worldwide. This upward trajectory in industrial profits is particularly significant given the persistent headwinds China faces. These include ongoing trade tensions with key partners and a domestic property sector still grappling with challenges. The ability of industrial firms to expand their earnings, even moderately, points to a degree of resilience. The slight acceleration in April offers a glimmer of hope. Fueling the fire. Beijing's stimulus toolkit is in action. The recent improvement in China's industrial profits is not accidental. It is in large part a direct consequence of a concerted push by Beijing to stimulate the economy. The government has deployed a wide array of policy measures. These are designed to support businesses and encourage spending. Among the key tools are significant tax breaks for companies. These reductions in the tax burden aim to free up capital for investment and operational expenses. Beyond tax relief, substantial government spending on infrastructure projects has also played a vital role. These initiatives create direct demand for industrial goods like steel, cement, and machinery. Furthermore, the People's Bank of China has taken steps to ease monetary policy. This includes carefully managed interest rate cuts. Major liquidity injections into the banking system have also ensured that credit remains available to productive sectors of the economy. One particularly interesting stimulus measure has been the introduction of government-backed trade-in programs. These programs offer consumer subsidies for trading in old items, such as electronics and appliances, for new ones. The effectiveness of these measures is now being reflected in the recent profit data. Riding the wave sectors are thriving under new policies. The stimulus measures implemented by Beijing have not lifted all boats equally. Certain sectors have clearly benefited more than others from these supportive policies. High-tech manufacturing, a strategic priority for China, has emerged as a significant winner. This sector saw its profits increase by a robust 9% year-on-year in the January to April 2025 period. The broader manufacturing sector as a whole also experienced healthy profit growth. It registered an 8.6% increase in profits during the same 4-month period. The utilities sector, which includes power generation and supply, also saw its profits rise by 4.4%. As mentioned earlier, the government's trade-in programs have had a direct and positive impact on specific consumer goods industries. Manufacturers of household appliances, for instance, reported a remarkable 15% surge in profits from January to April 2025. Furthermore, industries dealing with commodities related to new energy and high-end manufacturing are also reported to be performing well. These sectors are likely to continue benefiting from supportive government policies. Uneven tides challenges amidst the manufacturing boom. While some sectors are celebrating increased profits, the economic landscape in China remains uneven. Several key industries are facing significant headwinds, indicating that the recovery is not yet broad-based. The mining sector, for example, has experienced a sharp contraction in profitability. Profits in this industry fell by a substantial 26.8% year-on-year in the first 4 months of 2025. The automobile sector, a major component of China's industrial output, is also navigating a difficult period. Despite overall manufacturing gains, auto industry profits slumped by 5.1% during the same January to April timeframe. Another sector experiencing a downturn is the textile, clothing, and apparel industry. This traditional manufacturing segment saw its profits decline by 12.7%. When examining profit performance by ownership type, the data also reveals interesting divergences. Private enterprises appear to be faring relatively well. They saw their profits rise by 4.3% in the January to April period. However, state-owned industrial firms, or SOEs, saw their profits decline by 4.4%. The shadow of tariffs navigating global trade uncertainties. Despite the positive domestic stimulus, China's economic outlook remains clouded by significant external risks, primarily stemming from global trade tensions, the imposition of higher tariffs by the United States, and the potential for further escalations poses a considerable threat to sustained profit growth for Chinese industries. These tariffs directly increase the cost of Chinese goods in the U.S. market. This can reduce their competitiveness and lead to lower export volumes. Beyond the U.S., a growing number of countries are pursuing strategies to de-risk their supply chains from China. This involves diversifying sources of essential goods and reducing reliance on Chinese manufacturing for critical components. While Chinese exporters have shown some success in finding alternative markets for their goods, the overall export situation is still described as shaky. Global demand has not rebounded as strongly as many had hoped. The potential human cost of these trade tensions is also a serious concern. Estimates suggest that if China's exports to the United States were to fall by as much as 50%, it could put up to 16 million Chinese jobs at risk. This highlights the high stakes involved in the ongoing trade disputes. The uncertainty itself can deter investment and long-term planning for businesses. The challenge for Beijing is to navigate these external pressures while continuing to foster domestic sources of growth. A fragile foundation? Assessing the durability of China's gains. While the recent uptick in industrial profits is a welcome sign, market analysts caution that this growth may not yet be on solid ground. Several underlying domestic economic challenges persist, casting a shadow over the sustainability of the current recovery. One of the most significant issues is the presence of persistent deflationary pressures. Falling prices or very low inflation can be detrimental to economic growth. They can discourage consumer spending as people delay purchases in anticipation of even lower prices. Insufficient domestic demand is another major hurdle that China needs to overcome. While stimulus measures like the trade-in programs have provided some lift, overall consumer confidence and spending have been slower to recover than hoped. The property sector, a traditional engine of Chinese economic growth, also continues to face difficulties. While not directly part of industrial profits, its health has significant spillover effects on the broader economy. Addressing these deep-seated issues in the property market is crucial for long-term economic stability. Relying heavily on government spending and easy credit can lead to diminishing returns or create new imbalances if not accompanied by deeper reforms. For the current profit growth to be truly sustainable, China needs to foster more organic, demand-driven growth. The Dragon's Reach, China's economic policies and the world stage. China's economic maneuvers, particularly its stimulus policies and industrial performance, have profound implications that extend far beyond its borders. As the world's largest manufacturing hub, accounting for a staggering 28.7% of global manufacturing output, what happens in China inevitably sends ripples across the entire global economy. International markets and businesses pay close attention to China's economic indicators. This is because its performance directly impacts global supply chains, commodity prices, and the availability of a vast array of goods, from consumer electronics to industrial machinery. A strong and stable Chinese economy, buoyed by effective stimulus, could help to stabilize global supply chains that have been under stress in recent years. If Chinese factories are operating efficiently and meeting global demand, it can help to alleviate inflationary pressures in other countries and ensure a smoother flow of goods worldwide. Furthermore, China is a major market for many countries' exports. Robust growth in China can therefore boost demand for raw materials, agricultural products, and manufactured goods from its trading partners, contributing to their economic health. This interconnectedness makes China's economic policies a global concern. However, the nature of China's economic policies and its approach to trade can also create challenges. The ongoing trade tensions, particularly with the United States, and the broader push for de-risking already highlight the complexities and potential for friction in the global trading system stemming from China's significant role. The world will continue to watch closely as China navigates its economic path.